Interest. The easy-to-understand explanation for everyone. Today, we're going to take a look at one of the most powerful and most misunderstood concepts in economics, interest. It affects your money, your loans, your savings, your rent, your shopping decisions, the exchange rate, and even the future of the entire economy. But don't worry, you'll get it by the end of this video. Let's get started. What is interest? Interest is basically the price you pay to borrow money. Or to put it more simply, interest is basically the rent of money. If you lend someone $1,000 today and they pay you back $1,050 next month, that extra $50 is interest. Why? You stop spending money for a bit, and that costs money. Interest is basically the fee you pay for using someone else's money. That's all there is to it. Why does interest exist? There are 4 simple reasons why this is the case. The time value of money. Money's worth more today than it is tomorrow. These days, you can spend it, invest it, save it, or use it to make more money. Risk. When you lend money, there's always the chance the borrower won't pay you back. More risk equals more interest. Opportunity cost. If you lend your money to someone, you can't use it for anything else. Interest compensates you for that. So, let's talk about inflation. If prices go up every year, your money loses value. Interest stops you losing buying power. What even is an interest rate? The interest rate tells you how much extra you pay or earn on money. Here's an example. The interest rate is 20%. The loan is for $1,000. The total repayment amount is $1,200. If the rate is high, borrowing will cost you. If the rate's low, borrowing's cheap. Interest rates have a big impact on pretty much everything people do with their money. Types of interest. Interest comes in many forms, but here are the ones you meet in daily life. Simple interest. Just so you know, it's calculated on the original amount. So, this is about compound interest. Interest earns interest. This grows really quickly. So, $1,000 at 10% compound interest becomes. First year, $1,100. In the second year, the cost is $1,210. In the third year, the total comes to $1,331. It's great for saving. It's risky for debt. Just a heads up that we'll be charging a deposit interest rate. The interest you earn from just having your money in the bank. Loan interest. This is basically the interest you pay when you borrow money from a bank. This is the interest rate for policies. It's the rate decided by the central bank. This one decision affects the whole country. How interest shows up in everyday life. You don't have to be a banker to be affected by interest. It's everywhere. Credit cards. If you don't pay your balance, interest kicks in straight away. Bank loans. Personal loans, car loans, home loans, they're all about interest. We've got savings accounts too. Your earnings come from interest. The government has borrowed money. Basically, countries borrow money and pay interest to investors. Payment plans. Zero interest sales often mean you're actually paying more in the long run. Rent and housing. High interest rates make buying a home expensive. People are choosing to rent. When demand goes up, so does rent. Interest is a subtle force that shapes your daily life. Why do interest rates increase? Interest rates go up for a few simple reasons. We're seeing high inflation at the moment. If inflation is high, interest rates need to rise to protect purchasing power. Currency weakness. If the currency is losing value, higher interest can help stabilize it. The central bank is looking to put the brakes on the economy. Higher interest rates can mean less spending and borrowing. This is a higher risk scenario. If investors think a country is risky, they'll demand higher interest to lend money. Why do interest rates decrease? Interest decreases when governments are keen to see the economy grow. Lower rates mean borrowing is cheaper. People spend more. Businesses invest more. Inflation is low at the moment. If inflation is lower, interest rates can be lower too. Investors trust the economy. More confidence equals lower risk equals lower interest. Unemployment is at a high. Lower interest rates can help create jobs. What happens when interest rates fall or rise? Let's break this down simply. When interest rates fall, loans are becoming more affordable. People borrow more money. People are spending more money. Businesses are putting more money into it. The economy is picking up speed. But if there's too much demand, then we'll see higher inflation. When interest rates rise, loans can get expensive. People borrow less stuff these days. People are spending less money. There's been a drop in demand. Inflation is starting to slow down. But businesses aren't putting as much money into it as they used to. The economy is slowing down. There's a chance unemployment might go up. Interest is like the gas and brake pedals of the economy. Interest and inflation, the direct connection. Interest and inflation are like two peas in a pod, they can be good friends or bad enemies. If people aren't interested, they'll spend less, but prices will go up and inflation will rise. If people start to spend more, prices will slow down and inflation will drop. This relationship is at the heart of modern economics. So, why do central banks control interest rates, then? Controlling interest is the simplest way to control the whole economy. The central bank adjusts interest rates to keep things balanced. If we have lower interest rates, people will spend more, and that will lead to increased growth. If interest rates are higher, people spend less, and inflation goes down. The central bank's goal is pretty straightforward. Just make sure the economy stays on an even keel. How do interest rates affect your day-to-day life? Interest affects every part of your financial life. Rent. When interest rates are high, fewer people are willing to buy homes, so there's more demand for renting. This leads to higher rental prices. Car and technology prices. When interest rates are high, fewer people can afford to make big purchases, so demand drops and prices go down. Here are the grocery items. If interest rates go up, people spend less. If demand is lower, prices won't go up as quickly. Wages. Inflation, interest and wages tend to follow each other. Decisions about interest can have a direct impact on salary expectations. Final words, interest is the hidden engine of the modern economy, as we all know. Interest isn't just a number. It's the beating heart of the financial system. Interest is the cost of borrowing, the reward for saving. It's the tool that keeps the economy cool or hot. Finding the right balance between inflation and stability. So, here's the deal, we need to understand why prices, wages, rents, loans and markets behave the way they do. If you get interest, you get how modern economies really work. Interest is the quiet force that drives everything.